my mentors have always been men. So men would help me up the ladder, and I never had the female mentorship. So I'd reach out to females in leadership positions, and either they would see me as a competitive threat or old school and say, no, I fought my way to get up to the top. There are a limited number of seats at the table for women. You need to do the hard yards yourself. And I'd look around and I'd see, hold on, the guys were helping each other and the guys were helping me. Why, as women, weren't we coming together and helping each other? Yes, we're saying that, we want to have a positive impact on the world, but we can have a positive impact and make money at the same time and make better returns, but also operating both across the US and Australia. So there isn't any venture fund, even today, that looks like us.
From last week's episode on cross-culture, this week we go cross-continents, asking how do you build a cross-border VC fund that backs female founders before the world sees their value? Today on Billion Dollar Moves, we spotlight Marisa Warren, co-founder of ALIAVIA Ventures, a California-based fund investing in early-stage female founders across the US and Australia. A former Microsoft and SAP exec turned entrepreneur, Marisa teams up with Kate Vale, ex-Google, YouTube, ANZ, and the woman who launched Spotify to #1 in Australia. Backed by Carol Schwartz, the Forrest Family Office, and the Denholm family, they're proving betting on diverse teams isn't charity, it's smart capital. We dive into building a cross-border VC fund, what US VCs still get wrong about Aussie startups, and why diverse founders deliver 35% higher ROI. This is part of our special Merit in Motion series. Let's get into it. Marisa, 26 years in tech, Workday, SAP, Microsoft, you name it. You've run the gamut in your work life, and now you are funding the future with women at the helm. How do we get here?
How do we get here? By not following the rules. The first thing was when I defied my parents' sort of expectations for me and decided not to go to university. So I come from a very entrepreneurial family on both sides of my family. And at the age of 13, I had my first part-time job going through high school, working my grandma's art gallery, serving drinks. Even though I was underage, I was still serving drinks. But I got that appetite for making money and the entrepreneurial sort of spirit. So when it came to graduating year, I could not see myself going and being in another institution. I just wanted to get out and make money. So I think that was the sort of the first step in my journey of just not following the rules. I fell into tech really in 97. And then since that, I just fell in love with it because we've seen a lot of change over that period within the tech industry. 2001, I started selling enterprise software. I was able to work for some great companies like SAP, Microsoft, and Workday, both across the US and Australia. And the two types of roles that I had were selling enterprise software from tens of thousands to multi-million-dollar, multi-country deployments, through to then building channel businesses. So when SAP had acquired Business One, they went, okay, this product is for the SMB space. We can't take our top end of town reps to go and sell $10,000 worth of software because, quite frankly, they wouldn't get out of bed for, less than $1 million. So they needed to build a channel business to take this product to market. So I was headhunted specifically because I knew how to sell ERP in the Australian market and globally as well. And then I built that channel business for the southern region of Australia from scratch to 350 customers within 3.5 years. Went on to Microsoft, did something a little bit different. And at that time, we had this thing called the cloud. So the cloud came in, and there are some similarities between that now and AI as well. I was brought on to help accelerate Microsoft partners' profitability because they'd done some modeling and they went, okay, on average, it takes 18 months from Microsoft partner to become profitable. The longer it takes somebody to become profitable, the less interested they are in like selling your stuff. And so Microsoft wanted to shrink that gap down to at least 6 months to see them essentially just selling more Microsoft product. I was brought on to build out those programs. And then within a couple of months, we actually were revenue producing. So from idea stage to building that out across Australia and Southeast Asia. And at that time where we had, as I said, the transition to the cloud, there were entirely new business models that we were looking at as well. You couldn't just take the on-prem business model and apply that to how you were selling cloud software.
And what did that teach you about what you're doing now? I mean, are there any residual lessons from onboarding customers, going to market that you're now also bringing to your portfolio?
I think what I really took away from my time in corporate, besides sort of just, the corporate upbringing was really good. Even though I was in corporate, I was always in the rogue divisions. So when I started at SAP, myself and my boss, we didn't even have desks.
Wow.
Like we were not that important within the SAP organization. But that also enabled us we didn't have to be on the same CRM. We could do things our way. And then when we started getting bigger and selling more deals, then they were interested and started folding us into the rest of the business. The same thing with Microsoft, able to have a bit more freedom. But at the same time, that experience also taught me that both at SAP and Microsoft, if I help my partners become successful, they're going to sell more stuff. And that's ultimately going to reflect on my numbers and me being able to achieve my quota. And so that's what I take when I'm working with our founders. If I can help our founders be successful in their businesses, get them organically generating more revenue, we can help them with the fundraising and to accelerate that and to making their businesses more investable. That's ultimately going to have a positive impact on the fund and deliver the returns that we're looking for.
Yeah. So tell us about this fund and how you got to this point. I mean, after all those years of building within the corporate, you are building your own fund as an entrepreneur yourself.
Yes. And so if I say sort of break all the rules, so then going back from corporate, I was actually living in New York at the time. So this was back in 2013. And I'd just gotten to the point in my life where I went, I've had some really great career successes, but unfortunately, my mentors have always been men. So men would help me up the ladder, and I never had the female mentorship. So I'd reach out to females in leadership positions, and either they would see me as a competitive threat or old school and say, no, I fought my way to get up to the top. There are a limited number of seats at the table for women. You need to do the hard yards yourself. And I'd look around and I'd see, hold on, the guys were helping each other and the guys were helping me. Why, as women, weren't we coming together and helping each other? I just got to that point in my career where I went, you know what, I want to do something about it. And funny when you're really fired up about something. And I'm just living in New York, you meet so many amazing people on a daily basis. I was in an elevator just opposite Grand Central Station. And who do I meet but the Australian voice of Siri? Siri in your iPhone.
Yeah.
Yes, yeah. And we somehow, I think we just read Sheryl Sandberg's book, Lean In. And, I raised the topic. So, what about the piece about women sabotaging other women? And she goes, because Karen was besides the voice of Siri, so she's a voiceover artist, she's a singer and songwriter, been in the media and entertainment space for most of her life. And she had experienced the same thing within that industry. So we went on and did a little YouTube video together that got a lot of attention in New York because this was 2014. So we weren't really talking about it then. But like Cheryl had started shining the spotlight, but it wasn't. We were invited then to do an event at the Harvard Club. And from there, people were coming up to us and going, Marisa, Karen, you're on to this concept of women helping other women. It's funny how it evolved. I sort of stumbled across my passion and my purpose in life. I was always going to get there. I just had to get some of those great corporate learnings beforehand. And then I started ELEVACAO, which was a 501c3, not-for-profit. And that was really designed to help women tech founders get investment ready and funded. I didn't want another sort of like fluffy women's network. I wanted something that was going to have real tangible results and move the needle. And so over the 7-year period that I ran it, we had 175 women through the program that raised more than 120 million now and 5 exits.
And it was a pre-accelerator.
A pre-accelerator.
So tell us what that means actually in the context of what you were doing here.
How it started was just because I'd go into pitch events here in New York City back at that time. And, quite often they'd be at 6:00 at night in the summertime. And you'd go in, the air conditioning was off. It would smell of BO. It would be mostly men, like 99% men, beer and pizza. And it was just not the type of environment that I would want to go to or other women would go to. And so that's where it started, having these pitch events that were in an air-conditioned building, better food and wine, but the mix of audience was pretty much all 50-50 men and women, and then having women get up and pitch, but having it really structured, helping them prepare, and then having a judging panel as well. So just taking it up a level. And so what started as just helping them sort of get pitch ready for those events turned into then an 8-week program, but centered around that finance piece. So how do you pitch an investor, but also what is an investor looking for, and what does that process look like from initial reach out all the way to closing?
Yeah. So I want to ask you this directly because you've done this now for a while, from your time from, building ELEVACAO and 501c3. A lot of times, I speak for myself, a lot of my genesis story has to do with Lean In as well. I started Lean In Malaysia. That's how I got tuned into this, becoming an accidental activated feminist is what I call myself. And a lot of Lean In's criticism has been that it blames the woman, right? And that you need to pitch correctly. You're not speaking the language in a certain way. You need to lean in and grab, every opportunity. But at the same time, I think this was something we spoke about in Australia with Carol Schwartz, one of your LPs as well. And Carol's been in this even longer than both of us. But there are certain things in the system that needs to be redesigned to fully allow women to shine and be as good as they already are, versus changing them, versus doing a lot of these training programs that almost tells them to be more masculine. Any thoughts there on what you've learned along the way? Have you changed your mind on anything in this regard?
I'd always say to our women, look, I'm not trying to turn you into men. We weren't teaching them how to pitch like men, but we were at the same time highlighting some of the areas that can let them down in a pitch. And that's the apologizing, in some instances sort of thinking bigger, sometimes being, a bit too conservative and not backing themselves. But it's really what I distilled in our women through the program is think of yourself as you are the prize. If you get this right, investors are going to make a lot of money off you. So just change the narrative in your head around you're there sort of with a begging bowl out, wanting money. It's not being arrogant about it either, but it's just you have the power here to be able to create something really great, and remember that and bring that confidence through the pitching as well. And it needs to be you're not going to accept all the terms that an investor puts in front of you. There's got to be some pushback. It's going to be balanced as well. So there's a win-win on both sides.
Yeah. And now you're funding the great ideas. Of course, you and Kate. Kate comes from a very strong background with Spotify. Tell us more about the genesis of how that 501c3 essentially was one of the key trigger points for you to then build ALIAVIA.
Which is Latin for another way.
Wonderful.
So we're doing things differently. So take a step back to when COVID hit. That was, for all of us, a scary time. We didn't know what was happening. But at the same time, from a funding perspective, it just dried up overnight for female founders, both across the US and Australia. At that time, I was running ELEVACAO across both countries, and I'd moved back to the US in California. At that point, I went to Kate. I said, I've got an idea. I said, I think now is the time to start a venture fund. I've got this brilliant pipeline of female founders that are struggling to get funding. We know that the results have shown, we know how to pick the winners. And I think it's a ripe opportunity. So that was in June of 2020 that we decided that we wanted to do it. Never waste a crisis.
Yeah.
And then in 21 is when we were out in market and launched the fund. And there's a lot of work, obviously, that goes into sort of building a venture fund. And for us, neither of us had built a venture fund before. I remember Kate's first question was, I haven't done this, what do we do? And I said, well, I've Googled it, and I think that we need to speak to some lawyers to get the right entity structure set up. For us, it was then making sure that we were surrounded by great advisors as well, who had been there and done that before, but also we'd take their advice in and we'd craft our own path as well from there. I'm a big believer in that, getting the advice and then figuring out sort of what works for you. And then, we launched in 21.
Yeah. And of course, you're glossing over the journey here, but let's get into it. It wasn't all, peaches and roses as you had to build your fund. There were questions on the lack of a track record. Is the perennial question of, I liken it to an internship, right? Where someone wants to get job experience, buy an internship, but doesn't get the internship because they need more job experience. It's almost the same thing that a lot of GPs, especially women and people of color, face. Tell us about how you were creative, using even like a loan structure to be able to raise very quickly, build momentum, and really prove it out that you were the people to do this.
Yes, and that's a good question. And this was in Zoom era as well. That was a great time to start a venture fund because it meant we could keep our costs really low. We didn't have to travel and we could just have Zoom after Zoom. And we did that for the first 3 months of pitching. And literally, I don't know, we must have had like 8 Zooms a day. And we had no's for 3 months. And then after we went, okay, what are we doing wrong? Like we couldn't see it. And so we talked to our advisors. And one of them said, look, what I did when I started my first, and now he's got a few billion assets under management, he did this creative loan structure. The constant question or the constant comments that we were getting was, you've got great deals in the deck, come back to us when you've transacted those deals in market. And we're like, great, but we need the capital to be able to transact those deals. And then they'd go, yeah, come back to us when you've done that in market. That's then when he talked about that loan structure, we went, that is a way to be able to fund those deck in our pipeline. And we did that. And very quick, within a few months, we were able to get to first close. I raised $5.5 million for our first close. And so that for us was a real turning point. And it was just a basic loan structure, 12-month loan or first close, whichever happens sooner, and 6% interest. And we've actually done the same thing for Fund 2 as well, to be able to fund our deals and warehouse them before our first close on Fund 2.
Yeah, so instead of getting a repayment, they also had an option to then convert to equity into the fund as an LP.
Exactly, yeah, that's a very good point. So at first close, they had the option to either take the money, just the principal and interest, or just the interest, or roll that into the fund at first close and become a fund LP. We had 100% convert into becoming an LP. And interesting, you mentioned Carol Schwartz. So she was our anchor for Fund 1, but she was one of the no's initially.
Really?
Yes, she was.
Tell us about this. How did you convert good old Carol?
Well, we went back with this revised strategy. And then also said, we'd like you to be our anchor. Because literally when we got the email that came back, and was a very thoughtful email from her team, and going, these are the reasons why, both Kate and I, we cried. We were like, no, because we really wanted Carol as an investor. A few months later that we went back with this revised strategy. So the loan structure was a try before you buy type approach. And then they were able to work with us really closely for a few months. And then she put in a much larger check at the first close.
So I want to ask about this loan structure, which I think is important to unpack, because so many emerging managers, those Fund 1, Fund 2, Fund 3, are still today struggling with it even more so. We do a lot of work with LPs today, and a lot of the commentary that's come back is distributions have been tight, even from the earlier vintages, because we're waiting for 21, 22. How did you intend to repay that if there was not that 100%? What was your plan there?
There was no plan B.
There was no plan B.
There's only a plan A. We just had to make it happen. Kate and I really spent, a good 6 months thinking about our thesis and then going back. The really interesting piece is investing across the US and Australia. And I think the fun fact that a lot of people don't know, every $1 billion invested, Australia is now producing more unicorns than the US, China, or Israel.
Really? Wow.
Yes.
And of course, they've done a lot of the innovations like Google Maps that we don't know of.
Yeah, Google Maps, Wi-Fi, well, you have Canva, Atlassian.
That's right.
So I think the nature of the ecosystem in Australia is that it's really only exploded over the last 10, 15 years. Before that, there really wasn't a venture ecosystem. And it's very quickly grown. And now you have a number of funds with, $1 billion plus assets under management. We have a lot of the name brands that are coming in and investing in Australian companies as well. Sequoia, Benchmark, Excel, A16Z, etc. So they've cottoned on to that for a number of years now.
And what's driving that in the last 10 to 15 years? What's changed? I mean, you've been in this for a while.
The first major event was Atlassian. So, and then that money went, part of that went into building Blackbird. So you've had these sort of bigger events where you're getting more capital reinvested into Australia. Australia's always been this, they have this underdog mentality, right? We were the convicts that were, that were, deported from the UK. There's always, Australia just has this natural, punching above its weight. For a population of less than 26 million, we do very well at the Olympics in all areas as well. There's also, because it's been such a capital constrained market for so many years, inbuilt into the founder DNA is thinking about generating revenue right at the beginning. It's not this growth at all cost model. It's, okay, I'm building this product. How do I get customers buying it from day one? So they're thinking like that. They have to be more capital efficient because that's just the nature of it. It's been harder to get capital. And then when it comes to time to expanding to the US, they're also significantly undervalued compared to US companies. And so you get a really nice valuation uplift when they expand.
Yeah. So talk to us a little bit about, investing at the pre-seed and seed stages. You're investing in fund one, it was 250 to 750K, that types of checks, right? Mm-hmm. What was your strategy with regard to ownership and follow-on capital, making sure that you have that level of ability to, bring in the distributions that you were thinking of as now you're raising fund two?
So definitely a concentrated portfolio approach. So for fund one, just under 9 million US and 11 investments. And the 250 to 750, we typically do, because we are doing pre-seed, and a couple of those pre-seed investments have been idea stage. So back of the napkin, it is taking a real bet. So we'll do a smaller check there around the 250 mark. As they start achieving the milestones, then we'll follow on with the capital. And quite often we've been able to preempt the rounds as well and keep sort of good valuation as well for our dollars. But the strategy's been getting that 5 to 15% ownership. As I said before as well, the board seat, so we are much closer to the companies. But it's also, I think, a key thing has been getting in there early and really helping the founders think about the fundraise strategy and what that needs to be, how to value the business, what type of investors that they want to have on board. Mm-hmm. Are they just looking at Australian investors? Is it individuals? Because quite often we've been the first check in, so even before friends and family. So what type of capital, and at what point will they expand to the US for the Australian ones to raise from US investors?
Yeah, so 11, that's a very concentrated bet in your portfolio, and sounds like you're really hand-holding in some places because they're super early on. Beyond the investment criteria, what are your must-have qualities that you see in a founder, especially at that early stage where pivots are going to happen. Markets are going to change every single day. I mean, now with the geopolitics of the day, it's almost like, how do you even plan? What are you looking for in your founders as they're building here in the early stages?
It is the classic, we're betting on the founders. Mm-hmm. You can't bet on the product. A few of our companies that have in the pre-seed, before they've even launched the product in market, the product's pivoted a couple of times because of things like ChatGPT coming out. Right. And so for us, it's looking at, what is that resiliency of the founders? Do we think that they've got what it takes to be able to ride out the tough times? And also, do they have that ability, because we really like the B2B revenue model streams, do they have what it takes to be able to sell to corporates? Can they go and sell to a CEO of an organization, CXO? And we look for some of those early proof points. So sometimes they might have pilots where they've done that. And so it's a mix of consulting and tech where they still haven't come out with the MVP, but they've been able to sell into some big brand names. Yeah. And given my sales background, I'm looking, can they sell their product even at that very early evangelistic sort of stage?
And tell us some success stories. I know a lot of your value add is because of this exact mind of you being able to get into those customers, including one that you've helped recently with HubSpot. That, of course, our podcast is part of their podcast network. It's part of their network and sales strategy to get into those that listen to podcasts like this. Talk to us a little bit about your value add as a funder.
I think there's the two main areas that we focus on first. When we come in, they're quite often mid-fundraise. So it's helping them with that fundraise strategy and complete that fundraise. And we've been really deliberate in terms of the LPs that we've brought on board for ALIAVIA. And most of our LPs actually co-invest alongside us. So some have co-invested in like 6 of our companies.
Is that something that you actually pre-negotiate with the LPs? That if you come into the fund, you get co-investment deals as well?
Yes. So we don't spin up SPVs because, it's just like mini funds. Yeah. I mean, I just don't want that headache, but it's also been part of the value add. So for our LPs, we do all of the DD, we share that with them. We negotiate to be able to get extra positions in the companies. We share that with our LPs to be able to decide whether they co-invest. And just about every company that we have has at least one of our LPs that have co-invested. So that's part of it. So helping with the strategy, helping with investors, bringing investors on board. And then we very quickly shift gear to the revenue piece, because investor capital only lasts for so long. We need to help them to be self-sufficient as possible from a sales and marketing perspective. And it's getting quite tactical as well. It's looking at their people, their systems, their processes, their proposals, because we know if they do those pieces well and they can get the customers, that's just going to make the business more investable.
Yeah. So what are 2 to 3 sort of traps that you've seen founders fall into as they're thinking about growth at this stage?
One of the main things is rushing out to hire a salesperson too early. Founder-led sales is incredibly powerful. No one quite has the passion for the business that the founders do. But they also need to learn going through what resonates with the customers. Why are the customers buying? What does that journey look like? They need to do that, a dozen times more than just to build up that muscle and understanding before they start hiring people, because you don't know when you're starting off. You have a thesis around who you think is going to buy your product, but you don't know until you actually launch that in market.
How about from a cross-border perspective? I think that's one of the things that your portfolio companies look to you too, and that you have the expertise in US expansion, right? So I presume in both ways, a lot of Australian founders are looking to grow their market into the US. When do you think is the right time? When do you tell them, yes, tick, 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 you meet this criterion, you're ready?
I wish it was that easy. I really do. Every business is very different. Some of ours have expanded within a couple of months of us investing, and some have taken much longer. I think one of the biggest mistakes that I see that founders make from expanding into the US is just thinking that they can do the fly in, fly out, have some investor meetings, sell some deals, and I'll be able to. It doesn't work like that. This is the most competitive market in the world. And every state, as we know, operates very differently. But even within California, I mean, I live in Laguna Beach, and Laguna Beach operates differently to LA, to San Francisco, and we're still under California. I say to my founders, and that's part of our DD process, is are they willing to move to the US for a period of time to be able to establish a business, because they need to come over. What works in Australia might not necessarily work in the US, because it's, even though we speak the same language, there are a lot of different things culturally. Just back to that competitive comment before, where you have, coming out of investor meetings, you have founders that are emailing, straight away or within, 24 hours here in the US. Whereas in Australia, it might be a week later. You can't do that. It's getting onto it. It's on the ball. It's then the follow up as well, and the constant follow up, versus I think sometimes it can be a little bit more relaxed in Australia.
You've almost started as a generalist, right? And then narrowed down into the verticals, the 3 verticals. What are you seeing? I mean, it is 2025, we can't leave a conversation without touching AI disrupting everything. How are you thinking about the future of work and the verticals that you're now doubling down on?
And so for AI, I see it, eventually everything's going to be AI. We have a couple of native AI companies in our portfolio, and then we have some of your traditional SaaS businesses that are building then the AI capability. And when we're making new investments, we'll do it across both as well. But it's, how are they going to 10x that customer experience with AI? And that helps it sort of inform that product development roadmap for some of those traditional businesses. So one of our companies, Go Figure, which is a marketplace helping employees find, projects and match them with projects within their current workplace, but it's also helping to upskill them as well and coach them. We've been talking about where that industry is actually heading, and it's, people need to learn to be able to, how do they work with AI agents? So you'll have AI agents as colleagues or managers, and how does that then work with a human, and even doing performance reviews on your AI agents. So it's really sort of reimagining what that future workplace is going to look like. In health tech, there's so much more focus on the preventative side now. So one of our companies, Eugene out of Australia, is the at-home DNA testing combined with genetic counselling. And they started off with carrier screening for pregnant women and couples, and then going on to cancer and heart health as well. So what's your predisposition towards getting cancer or heart disease based on your DNA? And there's proven studies that if you have a predisposition towards getting breast cancer, for example, if you then have a healthy, clean lifestyle with the right types of exercise and foods and sort of lower stress, you can actually avoid getting breast cancer. So there's a lot that you can do on the preventative side. So I think we're just at the beginning there of really analysing our DNA to unlock our future health. We've just invested last year in a company called Ginkgo, which is helping kids and teens have a better relationship with their technology devices. So again, technology is here to stay, and our kids are suffering even more. We didn't have that when we were growing up, but there's, much higher levels of depression and suicide and anxiety. And a lot of it is wrapped up with that relationship that they have with their devices. And it's how, instead of the no screen time or cutting them off, it's actually teaching them to have a better relationship with their tech, and also being able to give some insights and forewarning for parents if there were going to be any potential issues down the track around depression or anxiety.
So these are very important areas of our future as a generation that you're investing in. What gives you hope in what you're seeing out there and what founders are thinking about the problems that they're solving?
What gives me hope is that I think we're just at the beginning of unlocking the power of AI. Like, it is just going to be so transformative. And these founders, just their visions to have a positive impact on the world. Yes, they want to build a venture scale business. Yes, they want to see that success, but they also want to have that positive impact on the world. That aligns very much with the ALIAVIA thesis as well.
And when you think about your journey, in the last couple of years, 2014 was it when you start ELEVACAO, and now with your fund, how have you seen the maturity of just the startup ecosystem in both the US and in Australia?
Founders are just much more sophisticated now because there's so much knowledge out there around how to start a startup, so much education. I think the piece, there's still the black box is the VC industry, like starting a venture fund. A lot of things I just learnt by starting a venture fund. And there are a lot of unwritten rules that you don't know until you start and you stumble across them. You're like, why isn't it working this way? Because I'm not playing the game the right way.
And that brings me to the last portion. We talked a little bit about planning your distribution strategy and how that works for a pre-seed fund that's super early on, that frankly, there needs to be a lot more patient capital. And yet we are in a capital constrained environment. It is no longer a ZIRP period of zero interest rates. There is pressure from LPs to see DPI beyond, the markups. That's no longer enough. How are you adapting to this? How are you thinking about your distribution strategy? Are you going out there and negotiating secondaries as we've seen a lot of our fund managers do? Or
I think we will continue to see the VC model evolve over time, but particularly, we are a pre-seed and seed fund, and so in our modelling, we're not modelling out until having returns until sort of year 7. Although we have already had our first exit, which was Loop in December of last year to a
Stingray, right?
Yeah, to Stingray. Mm-hmm. Yep, to a publicly traded company. So that was a great experience. That was ahead of schedule, but we're not pushing our companies to exit to generate liquidity for our LPs. We're straddling that. We're trying to be sort of like more of the patient capital, like the family offices, but at the same time, we will realize as we go on that there'll be an opportunity to take some money off the table. And that's what we, have built into our strategy, because I can't see us holding on until the IPO, especially with the IPO bar that's risen, significantly higher from what a company needs to look like from a revenue metrics and profitability perspective. So we need to be able to take some money off the table, but not, losing our position in that company to return some for our LPs, but also not forcing an exit that's too premature on our companies.
And so this points to LP alignment. You have some really strong LPs from Carol Schwartz, the Trawala Group, Robin Denholm as well from Tesla, and many other families that are thinking about investing in the future. What have you learned about just LP alignment, keeping the momentum going so that you can build, like you said, a franchise of funds, not just stop at fund 1, fund 2?
So I think the refreshing thing for our LPs is that because we weren't a spin out, we didn't come from the venture capital industry, we did things a bit differently. What I always learned in corporate was stakeholder management. You had to keep them updated on what you were doing and the progress, and there was an element of managing up and everything else. And so I've taken that same philosophy to keeping our LPs updated. So a tactical example is our quarterly updates. I've constantly gotten the feedback from our LPs that we're so much more transparent than other GPs that they have in their portfolio. We go into the detail around what's working well, but also what's not, cash in bank at the companies. We give a lot more detail. Yeah. And so there aren't any surprises when a company goes to zero, because that's the model. We will have companies that go to zero, but they're not getting that surprise. And that's something I learned in corporate around that stakeholder management. Right. You don't surprise your stakeholders. You keep them, they're coming along the journey with you, and they know what's happening with the companies, especially with a number of our LPs co-investing alongside us as well. So we're really that working with them as that trusted advisor to say, look, I give it to them straight. This is what I like about the company. This is what I think that they need to work on and some of the gaps. No one's perfect. This is early stage investing. Nobody has it completely buttoned up. And I think our LPs really appreciate just that transparency.
Yeah. And now as you look towards the future, as you're planning ahead here, what does the next fund look like? Is it the same thesis and extension, or are you doubling down on certain bets that you've learned over the last couple of years?
So Fund 2 is larger, a $25 million fund, but at the same time, that's about the right size. We wouldn't, for Fund 3, we wouldn't want to do more than 50 to keep doing the pre-seed and seed investing. We know that is a real strength of ours, to be doing the pre-seed and seed. So we'll continue to have those smaller funds. However, I want to make sure that we can continue to invest in every round. And so once we get to Fund 3, we may even have sort of like our growth stage fund or something that's specifically for follow on into some of our more growth stage companies and get some growth stage GPs involved in the fund as well. Yeah. So it's really being able to fund throughout the life cycle of a company's journey.
Yeah. And you mentioned earlier some of the hard lessons that you've learned. What was one unexpected lesson?
Part of me sometimes is like, how do we get these really brilliant LPs to back us? Like you said, like Carol, like Robin Denholm, like Nicola and Andrew Forrest, they have the largest family office in Australia. The list goes on of, like really successful people in their own right. So I think that's been one of the things that has been surprising. Everyone talks about it's a hard fundraising environment. For us, fundraising for Fund 2 is actually easier than fundraising for Fund 1.
As hopefully it should be, right? Because you now have the track record.
But even this market, but at the same time, I mean, I learned how to sell enterprise software in 2001, which was much harder than now, because we had 9/11, we had the .com crash, we had everyone buying software before Y2K to be Y2K compliant. So we had to be so much scrappier. And, but for me, there is always money out there, and you just need to knock on more doors to get there. But it's also making sure that you're getting the right capital in that's aligned with our thesis as well.
Yeah. So I want to double click on what you said, that with all the top families really backing you. Mm-hmm. What do you think was the driving factor of them saying, take my money?
I think, first of all, because we are very mission aligned. Mm-hmm. So yes, we're saying that we want to have a positive impact on the world, but we can have a positive impact and make money at the same time and make better returns by doing that.
For always finding another way. Well, we always end with a quick card game, and these are fire questions.
What core values do you want to leave behind? I have 2 girls, a 6-year-old and 3-year-old. And for them, it's really, really important that they believe that they can achieve anything that they set their mind to. Just because the female gender does not mean that they can't achieve anything or do anything that they want. That's been something that's been very important to me. And even making sure that I had the right partner in my husband that has that same sort of mentality as well. I just want that next generation of women to be able to just have that mindset.
Yeah, love it.
Who is always on your speed dial and why? My sister. So besides my husband, we both work from home. So,
he's there. Yeah.
He's there. I hear him, when he's on Zooms and stuff in the next room. Yeah. But my sister, because we just get each other. There's no apologizing. There's no explaining. There's no, we can have our whinge. We can celebrate things. We don't judge each other.
Yeah. Love that. Well, Marisa, thank you so much for your time and for your work in finding another way and showing us that many ways are possible and that women continue to outperform, and they're the largest undercapitalized asset that we have today.
Thank you. This is great.
And thanks so much for tuning in this week. You can subscribe wherever you get your podcasts and follow our socials on Sarah Chen Global to get the latest on the show. It would really help me out too if you enjoyed this to rate and review our show on Apple Podcasts and share your favorite episodes with a friend. I'm Sarah Chen-Spellings, and you've been listening to $1 Billion Moves.